Now that we have gone through and used our income statement and our balance sheet and a few select formulas to prepare the statement of cash flows for ABC Company, the second part of our task is to do a ratio analysis. And this ratio analysis is going to help us determine specific things about our company. We have formulas in here for measures of liquidity, how easily we can pay our debts. We have formulas in here for, the effective speed of our company, how fast we collect on receivables once we make sales. In fact, how fast, we scroll down, we can turn that inventory into a sale after we finish completing it. And then we have other ratios down here about how we finance our company and how effective we are at turning a profit. And then lastly, how well our company looks as an investment, earnings per share and price to earnings ratio compared to other companies in our industry. For all of the formulas that I'm asking you to do, I've given you a set of equations in this little formula reference table. And the first one we have is cash ratio. And the formula for cash ratio is cash divided by total current assets. Where am I going to find that information? Cash divided by total current liabilities. Where am I going to find that information? They are both balance sheet accounts. So I can just go to ABC Company's balance sheet, find the cash for 2021, divided by the current liabilities for 2021, and that is going to give me my cash ratio. So if I go, click in the cell for the answer, now like that, hit equals, go to the balance sheet, I have cash divided by our current liabilities. 90,000 divided by 42,000 equals 2.14. What does that number mean? It means that ABC Company has enough cash on hand to pay off all of the debts that are going to become due within the next year 2.14 times. Like right now, they have enough cash to pay all of the things they think they're going to have to spend on in the next year over 2 times. Well, is that a good number or a bad number? Let's compare it to something. We need to benchmark, as they call it. Let's benchmark against our own prior performance. Let's go back to 2020 and figure out what our cash ratio was then. So I'm going to hit equals, and I'm going to go back to our balance sheet, and I'm going to find on here that our cash on hand for 2020 at the end of the year was $74,000, and we had current liabilities of $45,000. So last year, ABC Company could have paid off their current liabilities 1.64 times with the cash they had on hand at the end of the year. So they're trending in the right direction here. Supposedly they have more cash than they did before. It's us comparing against ourselves. How do we compare against our competitors? That's what the industry average is for. We see that other companies in our industry have a cash ratio of about 0.5. So we are much more liquid, as they say, with the solvent, the ability to pay off our debts, than our competitors are. Current ratio is another measure of liquidity, and this time it's total current assets divided by total current liabilities. Let's take a brief detour to our balance sheet and see what other current assets we have besides cash. We have accounts receivable, we have merchandise inventory. So what this ratio is measuring is if we had a little bit of time to collect all our receivables and sell all of our inventory and collect all of the cash that comes from those sales and those receivables, how many times could we pay off our current liabilities with the cash we would have from liquidating our current assets? So if I go back to the ratio analysis tab in 2021, I'm going to hit equals, and our formula is just current assets divided by current liabilities. So in 2021, we had $160,000 of current assets divided by the $42,000 of current liabilities. Comes out to 3.81. If we could collect our receivables and sell all of our remaining inventory, we would have enough cash on hand right now at the end of 2021 to pay off our current liabilities, our existing short-term debt, 3.81 times. How does that compare to where we were last year? I'm going to go do the same thing. Hit equals, go back to the balance sheet, find our current assets were $141,000, divide them by our current liabilities, that is $45,000, and we come up with 3.13. So just like with the cash ratio, we're trending in a positive direction. we have more of an ability to pay off what is owed, given even a little bit of time to liquidate our current assets, even more so than last year, and we're well almost double above the industry average. So in that regard, ABC Company should be feeling pretty safe about being able to pay off their debt that's going to be coming due very shortly. At the same time, that means they have more money, cash, and especially in cash, but current ratio as well, than they really need to meet those immediate obligations. ABC Company could, if they wanted to, take on even more short-term debt and use that money that they've borrowed to help develop a new product or increase advertising, something that's going to help them be more profitable in the future. It all really depends if we should be doing that until we look at our profitability measures later on in this example. But for right now, it's good that we're not in the imminent fear of being in bankruptcy. But we do have a whole lot of reserve cash on hand versus what we actually are going to have to spend it on in the future. What about our ability to generate cash in the future? Our ability to sell inventory and turn it into cash after we collect on the receivables that come from that sale. That's what the AR turnover ratio, day sales and receivables, inventory turnover ratio, and day sales and inventory are for. We're going to start with AR turnover ratio. AR turnover ratio is a measure of how often you collect the average amount of receivables that you have on your books at any one given time. Like how many times per year you flip through your receivables. And the formula for it is sales revenue, found on the income statement, divided by the average of the last two numbers of AR that you have reported. And I put this in proper calculator syntax, the way that Excel wants you to read it, so you can just make sure you fill it in the same way that it does. We're going to start with sales revenue. So that's on the income statement in the cell I want to fill in. I'm going to hit equals. I'm going to go to my income statement, and I'm going to take our sales revenue of $1 million. I'm going to divide that by our average amount of receivables that we've had during the year. To do that, I'm going to start by hitting divide, open up two parentheses, and then I'm going to go to our balance sheet. And on our balance sheet, I see that we had $26,000 of AR in 2021 and $17,000 last year. So to figure out the average of those two, let's add them together, close the first parenthesis, divide by 2, and close the second parenthesis. So equals the sales revenue from your income statement divided by, open double parenthesis, current year's receivables plus prior year's receivables, close the first set of parentheses, divide by 2, close the second set of parentheses, and we come up with 46.51. So during 2021, we collected the average amount of receivables that we had on our books on any given day, 46.5-ish times. What about the year before? Well, we need sales revenue for the year that we're calculating for, and that's 2020. I've only given you an income statement for 2021. Make it convenient so you're not looking through a million different financial statements. Some of the information that you would have to get from the 2020 income statement or the 2019 balance sheet, I've instead provided for you in this little chart up on top. And here we have our sales revenue for 2020. It was $900,000. So we're going to do that same formula. Sales revenue for the current year. We're doing 2020, so 2020 sales revenue will be for the current year, divided by, open two parentheses, go to the balance sheet. Again, we're in 2020, so the current year's receivables would be $17,000. We don't have 2019's number, so I bet you that's in the table at the top of the ratio analysis tab. And it is. We had $10,000 in receivables at the end of 2019. Close that parenthesis and divide by 2. Close the second parenthesis, and we come up with 66.67. So last year, we flipped through our average number of average number of receivables on our books, 66.67 times. This year, we dropped significantly. We're down to 46.51. So it's taking us longer to collect on receivables this year than it did during the prior year. How scary is that? Well, if we compare it to our industry average, we're still well above the industry average. So it's not that scary. And we could actually take on new customers that we thought would take us a little bit longer to pay. And that could still, decrease that number down to a point where we're still above industry average. So we don't have to worry about our customers are very timely in paying. How timely are they? I'm not a huge fan of AR turns. It's a weird concept, but you need that formula to do day sales in receivables, which is much easier to grasp. See, if you take 365 and you divide it by your number of turns, how many times you flip through your average level of inventory, it gives you an approximation of how long it takes you to collect on a receivable after you've made the sale. So during 2021, it's taking us about 7.85 days to collect on a receivable after we made the sale. In 2020, if we took 365, divided it by that 66.67, we would come up with 5.48. So last year it was only taking us about 5.5 days to collect on a receivable after we made the sale, to convert that receivable into cash. This year we're up to almost 8. How scary is that? Again, compared to the industry average. And we see in the industry average that we're still collecting receivables almost twice as fast as the other people in our industry. So we don't have any worries from our customer base about them paying in a prompt manner. We have a very good set of customers that are paying in a very timely manner. Maybe we're offering a big discount for early payment. Maybe we don't need to offer that big of a discount. There's a lot of points to think about here, but the one point is we have zero issue with our customers actually paying us in a timely manner. Well, that's only part of the process, I guess, here of turning our inventory into cash. This is the collection on the sales part, but how long does it take us to actually sell that inventory after we finish producing it? And that's what inventory turns is for. That's what day sales and inventory is for. The formula for that is incredibly similar to what we just had for AR turnover ratio and day sales and receivables. But this time, we're going to do it for cost of goods sold, the cost basis of the inventory that we had, and the level of inventory that we had on our books. But we take COGS and divide it by the average amount of inventory that we had during the last 2 periods. COGS is on the income statement, inventory is on the balance sheet. So here in 2021, we're going to go to the income statements, find our cost of goods sold for 2021, which was $760,000. We're going to hit divide, and we're going to open up 2 parentheses, and then we got to go to our balance sheet to find the average level of inventory that we had. So we take the current year's inventory, add to it the prior year's inventory, close the first set of parentheses, divide by 2, close the second set of parentheses, and hit enter. And when I do, I come up with 16.17. Companies have an average level of inventory on hand. If they're a retailer, it's how much it takes to fill your shelves at any one given time. If you are a manufacturer, it's how much you have sitting in your warehouse that's completed and sitting in finished goods inventory on average at any one given time. That amount, that average level of inventory, ABC Company during 2021 sold it about 16.17 times during the year. How does that compare to the year before? We need our COGS, but this is for 2020. We only have 2021's income statement. But if we look up above in that extra information, cost of goods sold for 2020 is provided. It's $690,000. Well, let's divide that by the average level of inventory for the current year and the prior year compared to the year we're calculating for. We're doing this for 2020. So 2020's inventory would be the current year and 2019 would be the prior year. We can find 2020's inventory on our comparative balance sheet. We had $50,000 worth of inventory. Well, let's add to that what we had in the year prior. And the year prior would be 2019. If we go up in our information at the top, it tells our inventory balance at the end of 2019 was $70,000. We close that first parenthesis. We divide by 2. We close the second parenthesis. And when I do that and I hit enter, I come up with 11.5. So last year, we went through our average level of inventory 11.5 times during the year. That was below industry average at the time, assuming industry average in 2020 was similar. It was probably at least close to it. Set out to improve it, and we absolutely did. We increased our number of turns greatly. Again, turns are a weird thing to think about. We can think about it much easier if we just take 365 and divide by the number of turns to get our day sales and inventory. And for 2021, that was 22.57. What that means is that after we finished manufacturing a good, or for a retailer, after we acquired it from somebody else and put it out for sale, it took about 22.5 days to sell. In the year prior take 365, divide it by the number of inventory turns for that year, we come up with 31.74. So last year it was taking us about 32-ish days to sell a piece of inventory after it was sitting there in a finished sellable state. We got that down to almost 22 days. So we knocked almost 10 days off of our day sales and inventory. Again, we were probably above or at least close to industry average in 2020. We're now well below the industry average number of day sales and inventory in 2021. So this is a measure of how fast we turn what we do, sell inventory, into actual cash. And you can use these two numbers in unison to figure out how long it takes a piece of inventory to turn into cash. We sell it 22.5 days after it's manufactured. We sell it on account. So therefore, at that point, there's an outstanding receivable, which we know takes us about 7.8 days to collect. If you add those two numbers together, you get a little over 30 days. So it's taking us about a month to turn a finished piece of inventory that we sell into actual cash in hand, which is well below the over 42 days, almost 43 days that it's taking our competitors to do so. So we're very solvent. We have more than enough on hand to cover the debt which we have due upcoming. We're also very good compared to the industry at selling inventory quickly and collecting on the receivable that comes from that sale equally as quickly. So we're just really good at making sure we have cash in hand, which is a good spot for ABC company to be in.